Mike, you've been writing very extensively about all of the new rules, Basel III, and now you have the FDIC on top of that. What does this mean for the divergence between these mid-sized banks that have not seen these types of rules compared to the biggest of the big, which already have the buffers to weather this kind of a storm?
Well, if there's one conclusion from what's taken place this year, it's that Goliath is winning. The largest, most heavily regulated banks have outperformed on so many measures. They are more resilient, they have more capital, they have more oversight, they have stress tests, and this is completely different than the prior 50 years. So the performance of big banks has been really much stronger than many had expected, and that's in contrast to many of the regional banks, which are now going to have a lot more big bank supervision. Having said that, I'm quite amazed myself. This is my fourth decade in analyzing banks, at just how much change is going to take with the largest banks. I mean, for the last decade, you've had the stress test, you've doubled capital, you've increased liquidity. The big banks came to support the economy during the pandemic. I mean, I'd say job well done. Thank you, regulators. I thought mission accomplished. And then you have what's known as Basel III Endgame, and look out, starting the week of September 11th, it's the conference season on Wall Street. You'll have banks to say what just that Basel III Endgame means, and I think it means much more complexity, much more competition on an uneven playing field, and much more cyclicality, pro-cyclical. So get ready for a punch to the stomach when it comes to some of the reveals of what the Basel III Endgame does to the largest banks.
And we know that the banks are going to punch back. We know that they're going to try to fight some of these rules. But at the end of the day, they're going to have to also stomach some of these rules, too. What's the math here? Who gets hit the most in terms of the costs tied to this increased regulation? By the way, downgrades for a series of banks. By the way, issuing more debt potentially at higher. I mean, there are so many potential costs embedded in all of these changes.
Well, as an independent bank analyst, I'm just trying to find the truth. I see this as a real, debate between the banking industry and the regulators. And the regulators are rightfully on course to ensure a resilient banking system when you look at the history of the last 50 years. But the banking industry is correct and say, look at the last 10 years, and loan losses are half at the prior level. So there's three categories of risk. Credit risk isn't so much different, but I'll tell you that the market risk and operational risk, some of those changes are really a head scratcher, and I can't wait to hear what the banks say in a public forum about the actual math behind it, because we don't really know the math. I don't think the banks completely knew the math until they've worked their way through this.